From Wisconsin, Mr. Duffy, Vice Chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and Madam Chair, thank you for being here. I want to commend you for the last time you were here, staying for as much time as we would need to have everyone on the committee ask you questions. I thought that was fantastic. I was hoping that was going to be a continual policy, but maybe it was not as pleasurable as it was for us, as it was for you. But I appreciate you being here today. On June 18th, Representative Perlmutter and I, along with 84 of our colleagues, wrote a letter to the President asking that he appoint someone to the Federal Reserve with banking experience. I would ask that that letter be submitted to the record.
Without objection.
And I know yesterday Senator Vitter asked you about this very issue, and I think you indicated your support, that you would support having someone with banking experience, community banking experience on the Fed board. Is that correct?
Yes, I would.
And it's fair to say that your role has expanded. Traditionally, you were dealing with monetary policy, but through Dodd-Frank and the Fed's own action, you've had an increased role on the regulatory side, correct?
Yes.
And we were familiar with your dual mandate of maximum employment and price stability. Is it almost fair to say there's an unwritten third mandate that would bring us to protecting the country from systemic risk?
I think that's fair to say for the Federal Reserve, although it's not something that applies specifically to monetary policy, but we have a number of different tools, and I interpret that as an unwritten third mandate for the Federal Reserve.
Right. And kind of talking about that, right, you have the monetary policy side, and you also have the regulatory side. And just on the good government side, for us, we get concerned not about your blackout period during the FOMC meetings. We agree that you should have the blackout period. We do get concerned in Congress when you take the blackout period that applies to monetary policy, and when we ask you to come in and talk about the regulatory side, you use the argument on monetary policy and the blackout and use it for
we have no blackout period that applies to anything other than monetary policy in the economy. There is no blackout period with respect to supervision and regulation. And, it's conceivable that you ask someone to testify and they had a problem with I don't know what specifically you have in mind here, but our blackout period does not apply to supervision and regulation.
Thank you, and I would agree with you, it does not apply, but I would just reference, we had a December 2012 meeting, and there's a number of examples, but in December 2012, we wanted to have a hearing on Volcker, and we didn't get a witness because the blackout period was cited. So just if you take a look at that, we want to make sure that there is a blackout period that does not apply to the regulatory side.
It does not apply.
Okay. I want to, if you haven't noticed, this side of the aisle gets very concerned about the debt. I think that's why the chairman at our hearings will put up the fact that we have a almost $6 trillion debt. By way of your accommodative policy, quantitative easing, we've had historically low interest rates. You would agree? Today, I think through the Budget Committee, we'll pay $227 billion a year to service our debt. And you would agree we pay historic low interest rates on that debt, correct?
Yes.
Have you taken a look at what it would cost to service the debt if interest rates go to historic norms?
Well, I don't have those calculations in front of me, but certainly the Congress should be thinking about the fact that over time, as the economy recovers, interest rates will move back up to more normal levels.
And the cost to service that debt does not stay at $230 billion. Even if we were able to stop that clock from turning and we were able to hold it at $17.6 trillion, the cost to service that debt is going to increase dramatically when interest rates go up, correct?
Well, it will certainly increase.
Well, so there's not a correlation?
Yes. Higher interest rates will increase the cost of servicing that debt.
And some of the projections I've seen, if the debt stayed the same, it brings us to around $550 billion a year, an additional $300 billion that doesn't go to whether we're building our defense, whether we're using that money for food stamps, the social good of the country. And I think it's important that the country understand that there is a consequence for the spending binge that this town has gone on, and that we will pay it. as rates go up, and it'll have a significant impact on our budget in our out years, which might start, as you've indicated, next year. Thank you for your testimony. Thank you for your honesty in actually answering our questions. I appreciate that. It's very nice and refreshing. With that, I yield back.
Thank you.
Time is